All right, let's dive right in. Today, we're looking at a theory that's been making the rounds, and honestly, it's a big one. It's all about a potential shockwave, a huge one that could be heading straight for the markets.
So here's the puzzle. On the one hand, you've got corporate earnings just absolutely crushing it. But on the other, you have some serious analysts predicting a major market shock. It feels like a total contradiction, right? So what is really going on?
Okay, first things first, let's look at the bullish case because on the surface, things look fantastic. And it all starts with just how strong corporate earnings have been. Now, we're not just guessing here. We've got a really solid sample size. About 40% of the S&P 500 has already reported their numbers, so we have a pretty clear picture of how things are shaking out. And this is where it gets really impressive. A full 80% of those companies, they didn't just meet expectations, they completely blew past them. That's a huge number.
And we're not talking about squeaking by either. On average, earnings have come in 9% higher than what the analysts were predicting. That kind of performance suggests that corporate profit growth could actually be closer to 15% this year. And that could easily push the S&P up by the same amount. So everything's great, case closed, right?
Well, not so fast. Because while everyone is looking at all this great earnings news, there is a massive, and I mean massive, event looming on the horizon that could literally change the entire game.
Before we get to the wild numbers, let's get on the same page about this key concept, a liquidity drain. It's exactly what it sounds like. Imagine a giant vacuum cleaner sucking cash right out of the financial system. That leaves a lot less money floating around to buy stocks, bonds, you name it.
So this whole theory revolves around the upcoming public offering for SpaceX. The company is expected to raise a staggering $50 billion from the public. To put that into perspective for you, that is almost double the previous record for the largest IPO in history. But hold on, that $50 billion? That's just the tip of the iceberg. The company is also reportedly aiming to raise another, and this number is just astounding, $800 billion from private and institutional investors. You add that all up, and here's the crucial point. We're looking at a grand total of $850 billion being pulled directly out of the system to fund one single company. Now, to raise that kind of cash, investors are going to have to sell what they already own, creating some pretty massive downward pressure on the rest of the market. So the theory goes like this. Right now, market makers want to create this feeling of extreme optimism, this bullish sentiment, to make sure this gigantic offering is a success. The IPO is rumored to be timed for late June 2026. Then, once the deal is done and all that cash is sucked out, the liquidity drain could trigger a really sharp market correction, maybe 10 to 15%. Okay, I know that is a bold prediction. But are there any signs this is actually happening? Well, the people who believe in this theory say yes, there are clues. And it starts with the strange behavior of one particular tech giant. So if you look at the Magnificent Seven, the biggest tech stocks out there, you see something really curious. As a group, they've kind of been treading water lately, pretty flat, but one member has been totally breaking away from the pack. And this chart illustrates the point perfectly. Look at Google. It's in a strong uptrend, just clearly leading the group. So why? Well, one very interesting explanation is that Google was an early strategic investor in SpaceX. Some folks believe traders are buying up Google as a sort of proxy to get a piece of the action, anticipating the massive valuation that IPO is going to bring. But it's not just big tech that's acting a little weird. There are some really strange things going on over in the crypto market, too. Let's take Bitcoin, for example. It had a sharp drop over a weekend where not a lot of trading was happening. That's a classic move by a whale to shake out the smaller players. But then it staged this powerful V-shaped recovery. That pattern, a super fast sell-off followed immediately by a strong bounce, that's often seen as the signature of a big institutional buyer stepping in with a lot of money. A V-shaped recovery is one thing. That happens. But this next part, this is what really raised eyebrows. A highly complex and frankly very unusual deal involving the crypto exchange Binance and a major fund from Abu Dhabi. Okay, let's break this down because it's pretty wild. So the Abu Dhabi fund wants a piece of Binance. Simple enough. But instead of just giving Binance cash for equity, they did this. First, they gave $2 billion cash to a crypto family in exchange for their token. Then they gave those tokens, not the cash, to Binance to get their equity stake. So what's the result? Binance has the tokens, and the crypto family is sitting on $2 billion in cash. And here's the kicker. The family then took that $2 billion and just parked it in U.S. Treasury bonds, which are yielding around 4% right now. They now earn $80 million a year in interest, basically for free. It's an incredibly sophisticated, multi-step play that just shows how big money is moving behind the scenes.
So when you connect all these dots, what does it all point to? You've got a strong market, a historically massive IPO on the horizon, and some very unusual behavior from big players in both stocks and crypto.
This theory basically ties all these different threads together into one narrative. It suggests that a bullish market is being deliberately pumped up to support this massive liquidity event. And in the meantime, savvy institutional players might already be getting into position for the volatility they know is going to follow.
Now, you can look at this whole scenario in two very different ways. On the one hand, yeah, it's a huge threat, a sudden drain of liquidity that could catch a lot of people completely off guard. But on the other hand, history has shown us time and time again that every major drop like this on the S&P 500 has in hindsight been a tremendous buying opportunity. And really, that's the crucial question this whole theory leaves us with. Is this a moment of maximum risk that you should avoid at all costs? Or is this the setup for the single greatest buying opportunity we might see all year? That's definitely something to think about.